Welcome to the Empowered Investor Podcast. Have you ever felt overwhelmed by the sheer volume of choices and voices telling you how to plan or invest for your future? With his straightforward approach, host Keith Matthews of Toulette Matthews & Associates cuts through the noise to help you create a winning action plan for you and your family. The decision-making framework discussed in this show can transform you and your investment experiences and will increase your odds of becoming financially secure. Learn more and subscribe today at tma-invest.com.
Welcome to the Empowered Investor. My name is Keith Matthews, and I'm joined by my co-host, Marcelo Tabawada. Marcelo, how are you today?
Keith, I'm very good. I'm very happy to be back. It was a long break, but we've been busy with tax season and podcasting. You know, it's an amazing experience, but it also takes a lot of time. But again, we always said internally, right, that it's a marathon, not a sprint.
Yeah, you're absolutely right. We've taken about 6 weeks break to make sure that the tax season runs smoothly. We did one show last week with Nicholas Badoube, and we got great feedback. He's a very, very intelligent, great writer, and really promoting index strategies.
Yeah, I listened to the episode, I read the book, and I find his way of delivering the message is so fascinating because, you know, it's a subject that a lot of people are talking about. It's out there in the media, but the way he packages the messages and delivers it, it's really good.
Absolutely. Well, listen, today's show is on the mutual fund birthday, 100 years. But before we get into that, I want to congratulate you on your anniversary, Marcelo. 8 years with the firm, which is fantastic. And it's been an amazing 8 years. But also, this is our 4th year anniversary of the podcast. We started doing the podcast in March, April of 2020. Do you remember that time?
I still remember the day I was sitting in my couch working, middle of the pandemic. You gave me a call and said, now's the time to do the podcast. We need to get our message out. Clients need to hear from us. There's no perfect time of doing it. And everybody was a bit down, you know, with the fact that it was the first summer of the lockdown. I still remember that day when you called me.
And you're so accurate. If we were in lockdown March, April, we had no way of having our client meetings. No. We had no way of meeting clients on a regular basis. And so we said, let's start doing a podcast every 2 weeks and be able to engage and speak to clients and contacts and people we wanted to just connect with. So here we are 4 years later. It's been fantastic. I think the team has done an unbelievable job in terms of researching. It's improved our advice level in terms of making sure we're on top of subjects, doing our research. I think clients have really appreciated it and listeners have appreciated. So thank you to everybody for listening. Please give us feedback. Give us feedback. We want to continue for another 4 years easy, but we need to hear from people.
Yeah, absolutely.
So today, Marcelo, 100-year anniversary of the mutual fund structure.
Yeah, should we celebrate?
Well, it's a great show. It's a great topic. Mutual funds have liberated investors in so many ways, but let's go back in time here. Talk to us about how the mutual fund was created, how, the why, and the when.
Yeah, so it was founded in 1924 by a pioneering financier called Edward Leffler. He's essentially the one who created the mutual fund, and he decided to give investors access to a diversified pool of investing. So think of it like a container, right? So he created basically a container where people could invest in the stock market, because before you had to buy single securities, it was only accessible for the elite. Only people with a lot of money had access to like stock investing and having a portfolio. And also it was a time where there was a lot of fraud and like private investments and everything was very murky. So he came in, and the remarkable thing is that he was a door-to-door salesman. He was used to sell pots and pans, and he just revolutionized the industry by this invention.
It was quite an invention. I mean, prior to that, as you mentioned, it was really only individuals who had a lot of capital, who could have a relationship with a stock brokerage firm, who had enough money to get an advisor. And so most Americans, again, this was developed in the United States, most Americans just didn't have that kind of wealth.
No. And there's a few factors that gave the rise a little push of the mutual fund. You know, there was the rise of the middle class and the need to have wealth building tools that people needed access to. Also, the big shift we saw in the 80s from defined benefit pensions to defined contributions, because a lot of it was done through work plans and, you know, where you put money and your employer matches. So there's a few ingredients that had to converge for the mutual fund just to skyrocket the way it did. You look at it now, it's $16 trillion are managed globally in mutual funds or in
60.
this container. Yeah.
Okay,
60,
so
yeah.
go back to 1924, the mutual fund structure, and I like the way you've used container, the word container, because it's going to hold a whole slew of individual securities, whether it be stocks or bonds. But let's continue that language with container throughout the show, because it's good.
The one analogy that I thought about is before Henry Ford, right, and the Model T, only rich people had access to a car. And that democratized the access to mobilization and having a car. So it's sort of very similar in that way.
Yeah, 100%. So what are the pros of a mutual fund?
Yeah, so I think the biggest one, Keith, is the fact that you can now have a container and that gives you access to a pool of stocks, a pool of investments that is diversified and you have access to foreign markets. So for example, if you're a Canadian right now and you want to buy single stocks, you have access to Canadian stocks. You have access to US stocks easily, right? But let's say you wanted to buy some European stocks like Nestle or like a big company in Europe that you want access in your portfolio, or even Asian stocks. You couldn't. I mean, you could through different vehicles, but it gets complex. The mutual fund eliminates this problem. It gives you a container that you buy in Canada, and it gives you access to a diversified portfolio and access to different markets. That before was like you couldn't do that. You couldn't do it.
It was impossible.
Yeah, it was impossible. So then you have the fact that if you want to buy more of the same container, they can issue shares. And when you want to sell it, also you get a fair price. And it's just easy.
So the fair price is an interesting one too, which is this idea that a mutual fund has a net asset value that gets priced at the end of every single day. And so if you're an investor and you want your money back, you've got a fair mechanism to get your money back. If you're a purchaser and you want to buy, you end up buying a mutual fund and you get the day close and you get a fair price on those securities.
Yeah. And I mean, the biggest pro for me is it just democratized the process. It gave access to middle-class people and hardworking people a tool to build wealth that was reserved for the rich before, or the people who had more privilege at that time. And even now, we take it for granted, but we literally stand in the shoulders of giants. And the fact that we have access to this, and anybody, a student out of university can buy a mutual fund and get access to the stock market and have that is a remarkable thing.
Yeah. And then so if you put it in context, you're talking about having a monthly contribution for as little as $25 allows you to buy a position in a mutual fund and add to that on a weekly basis, a monthly basis. And this is the kind of thing back in the 1920s and 30s and 40s, which was just impossible to do.
Yeah. Now, is it the best vehicle? I think we're going to determine that in a bit. But I mean, for all intents and purposes, those are the pros of investing in a mutual fund.
All right. Thank you, Marcelo. So what are some of the negative aspects or the cons of a mutual fund? Now, let's think from a Canadian perspective now.
Yeah. So number one, I think everybody would agree, is high fees. A lot of very high fees are attached to this mutual fund, specifically in Canada. There's a lot of reports that point to this fact. And then also the lack of transparency around fees. I mean, how many times have you met a prospect or a client that comes in and you ask them, how much are you paying in your investments? And they're like, I don't know. I just simply don't know. It's not easy to understand how this products charge fees. And then there's some tax implications as well. If you hold mutual funds in a non-registered account or in a corporate account, the capital gains that are generated within the structure are passed down to the end consumer or the person who holds the mutual fund. So that could be another thing to think about in terms of being a con. So I think those are the three that I can identify. But yeah.
So your first point would be high fees. And we'll get into this a little bit later because not all mutual funds are created equally.
No, again, it's a container, right?
Right. It's a container. So it's important to understand that structure. When I look back in time, I remember when my father bought his very first mutual fund. And I think to me, the negative connotation around the mutual fund structure really sort of started coming into play in the 70s, 80s, and full speed in the 90s. And it had to do with, because it was such an interesting container and individuals weren't using these containers, the structures, there was a selling opportunity. So to me, the negative side of the classic mutual fund industry comes from a sales culture which is there to try to sell more of them. So my father, when he first bought his mutual fund, and he was so proud, he bought an RSP and he had a defined contribution as an engineer. He bought his first RSP in the 1970s. He bought a dynamic mutual fund. The front end load was 9%. So Marcelo, this predates you for sure, but 9% means you have $100. The sales commission is $9. So your starting portfolio is $91. You put $100 in and for the privilege of having access to these containers. You started with $91 and it was expected to grow. You definitely had to wait a year or two to get back to your initial amount of money. And then thereafter, hopefully over 20 or 30 years, it grew. But the real selling culture came in the 90s. And I remember that time very vividly when there was this massive push across the country from selling organizations to try to get people out of GICs, which at that point were paying 7 or 8%, and into the stock market, which was a brand new concept for middle-class Canadians because nobody had done it before. We grew up in a world where everybody invested in GICs. And so in that time, the mutual fund industry was dominated by independent mutual fund manufacturers, Fidelities, Templetons, Trimarks. And they had to have a sales force to sell them, which were independent financial planners. And that sales force had to be compensated. So they had all these compensation structures. And unfortunately, it encouraged some behavior and some movement and some tactics that I don't think are in investors' best interest. To me, the con of the classic mutual fund structure is this attachment to a sales culture.
Yeah, I could see that for sure. And, I worked in that world for a year after I graduated university. And I worked at the bank. I worked at a big mutual fund company. So I definitely know what you're talking about. It's this idea of you're buying business essentially, and you're trying to push product. And it has a sales culture attached to it, even now.
Well, I think there'll be a balancing act between trying to identify the better mutual funds versus the mutual funds that are perhaps exist more in a sales culture. But again, that's less the container issue and more the selling philosophy behind it. But let's switch gears now and talk a little bit about how Canadians invest in mutual funds and sort of the evolution of this process and what that looks like. And then we'll compare Canadians to how our counterparts in the United States invest. And then at the very end, we're going to have some suggestions and recommendations and some good news for Canadians.
Investing is a solved puzzle. We can get a broad market exposure portfolio in a boring, diversified, and lowest possible cost vehicle. But Canadians still continue to choose the high fee mutual fund to invest their money. So most Canadians pay high fees and don't even know it. Canadians aren't as sold on the idea of choosing better products that have less fees. So right now, $2 trillion are residing in Canadian mutual funds compared to $400 billion in ETFs. We'll get into what ETFs are in a second. So the remarkable thing, Keith, is that a few years ago, the Mutual Funds Dealer Association had a study, and 1 out of 5 Canadians knew exactly how much they were paying into their mutual funds or the products that they had. So it's mind-blowing to me that we have a lot of advances in the industry, better products, but Canadians continue to choose high-fee mutual funds.
Yeah, so that's an overall theme. And I think the opportunity here is, again, for improvement. Let's look at the 10 largest mutual funds in the country. So when we pulled up this list of the 10 largest mutual funds, when I actually first did it, I was surprised. Actually, maybe not so much, but 8 are bank-owned mutual funds. And Marcelo, I'll tell you, back in the 90s and even the double O's, when you look at the top and the largest mutual fund in Canada, they weren't banks. Banks weren't even in the industry. They were all independent mutual funds. So it would have been a Fidelity. It would have been a Templeton. It would have been a Trimark.
Yeah, someone specialized in
it.
It
might have been actually been Altamira at one point, although I can't remember. All these are names that are not even close to scratching the largest ranking. So the number one mutual fund in Canada, largest, is the RBC Select Balanced Fund at $50-something billion with an MER of 1.9 something.
94.
94.
Yeah, 1.94.
So when we look at that relative to an exchange-traded fund, it's 10 times as expensive as a exchange-traded fund or a low-cost mutual fund that's following an index strategy. So that's just the largest one. So there's 8 more of these in the largest 10. So what's happening is banks are dominating the mutual fund industry in Canada.
We have an oligopoly.
This is where Canadians are investing in the mutual fund structure. So how big is the mutual fund industry?
So I'll tell you, I have the data right here. So we have in Canada right now, there's $1.8 trillion overall in the whole...
In mutual funds?
No, assets under management. In total in Canada, you have $1.8 trillion. 83% is invested in mutual funds. 17% is invested in ETFs.
And the vast majority of mutual funds, they're all over the map. There's some high fee funds in there. There's some low fee funds in there. But by and large, the largest mutual funds are all bank owned.
Yeah. And the average fee is like 1.5% of mutual funds in Canada.
Yeah. And the high fees, some of them include advice, some of them don't. The worst scenario is a person being in a high fee mutual fund and not getting advice. You could argue that if you were in a moderate to high fee fund, but you're getting good advice, there's better value there. There's a few boxes being ticked, probably not ultimate. But to me, fundamentally, when you think about business strategy, the issue that Canadians face is that the mutual fund industry is dominated. The manufacturers are the distributors. And you don't want that in any business. Manufacturer being the bank, being a manufacturer of product, they are also the distributors of product. So when the manufacturer and the distributor work together as an organization, they have a tendency of being able to squeeze out additional profits, charge more than perhaps they should. Add to that we have an oligopoly of 5 or 6 large financial institutions. You end up with a very, very high fee environment, which is why Canadians, we're kind of stuck here until individuals kind of see how they can move forward in a different fashion.
And you look at the numbers, right? The mutual fund launches per year also still are being dominated by mutual funds. So we know it's a worse product than a lower cost product. And there's still like most of the launches are towards this product that is high fee.
I circle back to this whole idea of the manufacturer and the distributor. In the United States, what the registered investment advisor model is, the person giving, the organization giving advice. They have the same sort of registration as our firm. The organization giving advice is not attached to manufacturing. They are independent and they go towards the best product for the best fee, and they provide that and they build advice to clients. When you're dealing with the manufacturer and the distributor building those containers together, they are trying to build the most profitable container they possibly can for them. And that, I think, is a fundamental issue that Canadians are kind of stuck with and that we have to figure out how to navigate around. Good news is there are more options. So let's continue, Marcelo. That's how do Canadians invest. So how do Americans invest? Like, what's comparable when we think of our cousins to the south?
So investors in the US are choosing the right thing right now. And you see it in the numbers. About more than 50% of the market is dominated by passive investments in the United States. That was the latest number that we got. And it's a testament that Americans are really moving towards the right approach.
Well, it's interesting, that observation, because we looked it up offline before, because the number was like 45%
in 2022,
3 years ago or 2 years ago, and now it's 50%. So what you're alluding to, and the US market is a large market, 50% of assets under administration in the United States by individual investors is in index products. Now, it might be in an exchange...
Low fee.
Yeah, low fee. It might be in an exchange-traded fund, or it could be in a very low-fee mutual fund like a Vanguard, which is an enormous, extremely successful, very could be a dimensional fund advisor strategy. Right. These are all low-fee mutual funds, but they're index or passive. So 50% of Americans are choosing the passive approach, which tends to be more aligned with independent advice as well, right? So independent advisory firms tend to use those like us, tend to use those strategies more.
And you see the outflow too. The money that's gone out from actively managed products in the US to passively managed products is huge. So this growth has been happening for a lot of years now.
Well, that's a global trend. And in Canada, we're still quite a bit behind in that. I've been speaking about this for 25 years, Marcelo, and as a firm, we've been doing this for a long time, but Canadians just aren't there yet because we're back to that. Who's the manufacturer? Who's the distributor? Distributor being the advice provider, where you get your strategy from.
So actually, the amount of passive investments in Canada, it's only 15.5%. The US in 2013 was at about 24%. So it doesn't make sense to me. But we know why, right?
We know why, and it's an advice issue. But the irony here, Marcelo, is that when I look at the US an actively managed strategy in a mutual fund structure is often around 50 to 70 basis points. So Americans are choosing, they have access to low fee mutual funds, whether they're active or not. They have access to low fee. In Canada, we don't have access to a lot of low fees. A lot of the low fees that used to be around by the Philip Sager North organization, they were bought out by the banks. So Americans who have access to low fee are choosing even lower fee. And they're going into passive investment vehicles, whether it's an ETF or a Vanguard solution or dimensional, all growing strategies. Canadians, who you would think would gravitate, they have way more to save in dollars and cents. The opportunity is way bigger for them to move to this direction, yet we're still kind of stuck in that old-fashioned way across the country. The data shows that people haven't gravitated as fast as they could. So to me, I look at that and go, that is an incredible opportunity.
It is.
For Canadians to start improving the way they invest.
Yeah, I mean, we keep seeing reports over and over about how fees make a huge difference in your returns and they can have a big impact in your retirement. So if you are stuck constantly in like high fee mutual funds, that's eating your returns. And I think just because this is what I don't understand, right? It's the way also the product is built is people think there's no fees attached. Like how many times I've spoken to people that they feel or think that their mutual fund charges no fees, that it's a free product. It's crazy.
Yeah. So we've alluded to the ETF, the exchange traded fund. It's an anniversary for the exchange traded fund as well, not a precise, because the first exchange traded fund was developed in Canada and it was called the TIP, the Toronto Stock Exchange Index Participation 35, and then there was the HIP, the 100, and then there was the SPDR in the United States done by the Amex in 93. So we're about that 33-year anniversary. So it's had an incredible growth as well. So you have a mutual fund structure container that's got a 100-year anniversary. You have an exchange traded fund container that's now got a 30-year anniversary. And it's fascinating to see these investment vehicles right in front of us. Investors have great choices now, way more than ever before.
In Canada, there's a Vanguard portfolio of ETFs. You can buy one portfolio of ETFs, one product, right? And it'll cost you like 26 basis points, 0.26%. And you'll have access to a broadly diversified portfolio of a very good investment philosophy. So it's remarkable, right? Like the fact that we can do this now, it's helped a lot of Canadians. But as you can see, I just wish more people would gravitate towards that like we've seen in the US. I think Canadians will eventually.
It will come. I think there's a couple tipping points. I think the tipping point away from working with a manufacturer distributor model, which is the bank model, is coming. I think Canadians are actually realizing that this is not in their best interest. Their best interest is to not have that because there's a conflict and there's a high fee environment. So I think you're going to see a tipping point towards independent advice much faster than ever before. You're going to see Canadians, I think, move way quicker in terms of adopting and embracing index and passive investment solutions, whether they use the ETF container or the mutual fund container. That trend, I think, is really going to push forward in the next 10 years.
Yes, I agree. And we're seeing it now, there's more thirst for independent advice and evidence-based investing. And you know what's remarkable? There's a lot of good guys now entering the industry. Like I'm on LinkedIn, I'm very active on LinkedIn and social media. And I see all these young kids entering the industry now and being super active and following this approach, passive investing, evidence-based and fee for service, independent advice. It's very encouraging to see.
Yeah. So let's wrap up, Marcelo. Today's show was not supposed to be necessarily a long show. We were going to celebrate the mutual fund 100th year birthday. So quick comments to end, and then let's wrap it up.
I think my comment would be, it's remarkable how easy it is to fall into negativity and feel like everything is broken in the world. But the fact to me that it reminds me that we are in a good period of human history, right? Not only medically and economically and a lot of things that are working, but the fact that we can buy a portfolio for a very low fee and have diversification and have this wealth building tool accessible to anybody is a remarkable thing. And we take it too often for granted.
Yeah, I agree 100%. So I'll end with simply saying great innovation 100 years ago in the mutual fund. The exchange traded fund, although we're not celebrating it today, a 30-year anniversary was fantastic. 4 years anniversary for our podcast, Marcelo, which is wonderful. Thank you to the listeners. Please continue with your comments. And Marcelo, congratulations on your 8 years at our firm.
Thank you for listening.
Thank you so much, everybody, and have a wonderful week.
You've been listening to the Empowered Investor Podcast, hosted by Keith Matthews. Please visit tma-invest.com to subscribe to this podcast, learn more about how his firm helps Canadian investors, or to request a complimentary copy of The Empowered Investor. Investments and investing strategies should be evaluated based on your own objectives. Listeners of this podcast should use their best judgment and consult a financial expert prior to making any investment decisions based on the information found in this podcast.